What's up guys, welcome back to Dividend Life. In this video I want to share with you a option trading strategy that I will be playing around with and how I made 7% return on investment instantly. In Robinhood you have 4 types of trades you can make. You can buy a call, buy a put, sell a call, or sell a put. When you buy a call, this gives you the right to buy 100 shares at the strike price by the expiration date. When you buy a put, this gives you the right to sell 100 shares at the strike price by the expiration date. When you sell a call, this gives you the obligation to sell 100 shares at the strike price by the expiration date. This means you need to own 100 shares before you can execute this type of trade. When you sell a put, this gives you the obligation to buy 100 shares of the stock at the strike price by the expiration date. What this means is that you need to have enough money to buy 100 shares at the strike price. The strategy that I will be focusing on is selling. Alright, let's get into my portfolio and go to Ford Motor Company. This is a stock that isn't paying me any dividends at the moment because they suspended them, and I think this is a perfect opportunity to learn and try my options trading strategy. So under the trade options in Robinhood, you can get a little more insight into how some of these options trades work. I think the price of Ford is going to go down, so I selected the down button, and I'll be executing a sell a covered call. Again, this gives me the obligation to sell 100 shares of Ford at the strike price by the expiration date. The great thing about this is that I'll earn a premium up front, which I can pocket. Let's take a look at some of the expiration dates at top. If you scroll through, you can see many different ones. And if you select one, like February 12th, you can see that there are many different strike prices. You see $11, $10.50, $9. So these are all different strike prices in which you can select for this particular expiration date. Let's take a look at the $12.50 strike price. If you click on that and then click on the bid ask link, it will show you some stats. What I like about this is it shows you the volume of this particular contract, what the high is, what the low is, and what it's going for now. So I'm going to execute one contract for this particular strike price at expiration. And here you can see that I'm getting $6 minimum credit, but I'm putting up 100 shares of Ford as my collateral. I swipe up and now my contract is pending for someone to purchase it. So I received $6 up front and paid $0 commission. I waited a few minutes for someone to purchase that contract, but no one did. So I canceled that one and looked for a different contract. This one had a strike price of $12, and this time I received a $7 premium up front. What I'm showing here is how the price of this contract changed over the course of the week. As you can see, this contract expires today, and the strike price is just below $11.50, so far away from the $12, which makes sense for this contract to be so cheap because the likelihood of the price of Ford to get to $12 is low. So what did I end up doing? Because I have the obligation to sell 100 shares of Ford, I went back to go buy the right to buy 100 shares of Ford at my strike price. So taking a look at the bid ask stat menu, you can see that everyone wants to sell it at $1 for this contract. The reason why it's so cheap is because the price of Ford is unlikely to hit $12 on expiration date. So I'm going to buy one contract, and what this does is releases my collateral and remove my obligation to sell 100 shares of Ford at $12. My trade is complete, and as you can see, it brings me back to the main menu and there are no more open contracts. So what does this do? This frees up my 100 shares of Ford so that I can repeat and sell another call. So I'm going to look at what the price of Ford has been over the last week and last month. So you can see Ford has been bouncing around between $11 and $12. So I think a $12 strike price is reasonable. So by selecting the expiration date of February 19th, I would obtain a $8 premium up front for selling a $12 call. But upon selecting that trade option, I decided, you know what, let's go a little lower and choose a $11.50 strike price. Now this particular contract is enticing. The volume is pretty good, over 7,000 and almost a 70% chance of profit. If you look at the other strike prices below, they provide different upfront premiums but lower chance of profit. So I'm going to stick with the $11.50 strike price. Here, I'll be receiving a $20 upfront premium, but I would be obligated to sell 100 shares of Ford at $11.50 if someone chooses to exercise that. So what can I expect from this? Well, if the price stays below $11.50, no one will want to execute my contract. Why? No one's going to buy my shares at $11.50 if it's cheaper to buy from the market. So let's get into the meat of this. How did I earn 7% return on investment instantly on AMC? So to play around with this strategy, I ended up buying 100 shares of AMC at $5.75 per share. I went on to sell a call contract with a strike price of $6 by the expiration date of February 19th, and for that I obtained a $41 upfront premium just to have the obligation to sell 100 shares of AMC at $6. As you can see, when I sold this contract, it was worth around $40, but over time it has decreased. Now it's worth $26. That's because the share price of AMC has decreased further away from that $6 strike price. So let's recap what I did. I bought 100 shares of AMC at $5.75 for a total investment of $575. I sold a call contract at a strike price of $6 expiring February 19th, and for that I received a $41 upfront premium. Now because I have the shares still, any gains or losses are unrealized, so those don't count towards my return. So $41 over $575 gives me a 7% return on investment pretty much immediately. So I'm pretty excited about this option trading strategy. So be sure to like this video and subscribe to my channel for future updates on how this turns out for me. Thanks for watching. We'll see you next time.